Welcome to the deep dive. Okay, looking at the sources you sent for this week, starting November 10th, 2025, it's a bit of a head-scratcher, isn't it?
It really is. You've got the S&P 500 sitting up there at, what, 6,729? That's barely at like 2.8% off its all-time highs. Looks great on the surface.
Right, looks fantastic. But then you dig just a tiny bit deeper and, two big things jump out. These 4 Hindenburg Omens signals all bunched together.
Yeah, within just 36 days. And then you've got big tech going on this massive $75 billion debt binge, basically to build AI factories.
So our mission today is really to unpack that disconnect. Why does the index look so healthy while apparently the average stock is, struggling? And what are the key things you need to watch this week?
Exactly. It's this contradiction we need to explore. And we should also keep an eye on Bitcoin. It's testing that critical $98,000 support level, currently around $102,290. Gold's just sort of consolidating near $4,001.
Okay, let's start with the Hindenburg Omens. 4 confirmed signals between mid-October and early November. That sounds ominous. Pun intended. But what does it actually mean in simple terms?
Yeah, well, it basically signals a fractured market. You're seeing a statistically significant number of stocks hitting 52-week highs and 52-week lows simultaneously. Think about that.
Extremes pulling in opposite directions.
Precisely. On October 29th, for example, we saw 476 new highs, but also 170 new lows. Both were way over the 2.8% threshold. Plus, the S&P was above its 50-day moving average, and the McClellan oscillator was negative. All the boxes ticked.
But how reliable is this? I remember hearing single omens aren't great predictors.
You're right. A single omen, maybe a 20-25% chance it predicts a major drop, but a cluster like this, 4 signals. Historically, that bumps the reliability up to maybe 35%, even 40%. It's a serious flashing yellow light for internal market health.
Interesting. But you mentioned the real danger isn't just the signal, it's concentration.
Ah, yes, that's the big one. Your sources point out that just 7 stocks, you know the names, Microsoft, Alphabet, Amazon, Nvidia, Meta, Apple, Tesla, they now make up a staggering 43% of the entire S&P 500's weight.
43%, wow.
Highest level since the dot-com bubble peak in 2000. It's like balancing the whole market on, 7 giant Jenga blocks.
That's a good analogy. So if one wobbles...
Exactly. It sets the stage for what traders call a violent rotation. If 1 or 2 of those giants stumble, maybe bad earnings, maybe some regulatory news money doesn't just trickle out, it gushes out of those leaders and into other sectors. That causes huge destabilizing swings for the whole index.
And these same giants are the ones taking on that $75 billion in debt for AI.
That's the thing. Companies like Amazon, Google, Microsoft, they're issuing billions in bonds specifically to fund AI data centers. It shows incredible conviction in the AI future. Massive conviction.
Well, there's a catch, right?
Always. The risk is they're borrowing at maybe 4% or 5% interest rates for these huge projects that, frankly, won't generate significant cash flow for maybe 2, possibly 3 years. Expectations are sky high.
So very vulnerable to a shock. Like, what if Nvidia misses earnings? Or the Fed suddenly sounds way more hawkish than expected?
Precisely. That whole narrative could unravel fast. Although, on the flip side, the demand seems real. Your notes mention SanDisk and Micron are reportedly sold out of AI components through the end of 2026.
So the picks and shovels play is working. People need the gear.
Demand is definitely there.
Yeah.
Which creates this tension. Proven long-term demand versus immediate financial risk and market structure fragility. And that leads us straight to the absolute linchpin event this week.
Thursday morning, 8:30 a.m. Eastern. CPI data for October.
That's the moment. Right now, the market's pricing in about a 70% chance the Fed cuts rates in December. If that CPI number comes in hotter than expected, poof, those odds evaporate.
And stocks likely crater. That violent rotation could happen right then.
It absolutely could. So let's talk about the technical lines in the sand for you to watch. S&P 500 is at 6,729. Critical support is the 50-day moving average down at 6,650. A clean break below that. Look out below, maybe towards 6,600 fast.
Okay, 6,650 on the S&P. What about the NASDAQ? QQQ closed just above $600.
Yeah, QQQ at $600.39. That $600 level is huge. It's psychological support in the 50-day moving average. If we lose $600 decisively, you could be looking at a fairly quick, maybe 8% drop towards the $582 area.
And Bitcoin. You mentioned 98K support earlier.
Right. Bitcoin's hovering around $102,290. The really key zone is $98,000 down to about $93,000. If it loses $93,000, expect massive liquidations. A lot of automated stop losses are likely clustered right below there.
Got it. And we also have some key earnings this week that tie back into that AI infrastructure spending.
We do. Cisco reports Wednesday after the bell. Watch their commentary on AI networking orders and backlogs. Then Thursday after close, Applied Materials gives us a read on the broader chip equipment spending cycle.
And briefly, you flag SoundHound AI, SOUN, high growth bet.
But very expensive. It's at $14.14. Yeah, growth is impressive, 68% year over year, but it's trading at something like 40 times price to sales. That's steep. Zero room for error. Support is tight, $13.70, $14. Needs to hold.
Okay, so summing it all up, we have this powerful AI narrative, strong earnings, and hopes for a Fed cut pushing things up.
Butting heads directly with extreme market concentration, those Hindenburg warnings, and key technical levels under pressure. The bull market feels fragile this week.
Very fragile.
So the final thought for you listening.
It's all about Thursday morning. Respect the price action right around that 8:30 a.m. CPI release. How the market reacts in that first, say, 30, 60 minutes will likely tell you if the concentration risk gets ignored or if it becomes the trigger that defines the market's path into the end of the year.
A critical few days ahead. Thanks for breaking that down.
This weekly Market Navigator analysis is for educational and informational purposes only and should not be considered financial advice. Always conduct your own research before making any investment decisions. Paper trade ideas mentioned in this episode for your better learnings.